Leave work and let Medicare keep reading your last year's tax return, and you pay $1,148 extra on income you no longer earn. That charge hits every month, automatically, until you file the form that stops it. Not a phone call warning you, not a letter explaining your options, not a prompt from your tax software. 5 federal forms can put real money back into a retired household. None of them trigger on their own. The government is not going to knock. In 2026, the first IRMA surcharge adds $1,148 per year to a single retiree's Medicare bill, calculated on 2024 income, while that retiree is living on a 2026 retirement check. One form, about 20 minutes of paperwork, is the mechanism that resets that billing, and most people never file it. The other 4, an amended return for a deduction. Your 2025 return may have missed a reduced RMD penalty, a waiver for the year your paycheck stopped, and a first offense forgiveness the IRS frequently approves for anyone with a clean record. That last one is the one almost nobody thinks to ask for. I am your guide to real-world retirement decisions. We are going to walk through these slowly, one form at a time. In the next 15 minutes, who qualifies, what to file, and what comes back. Before Form 1, if this is the research your financial team never walked you through, hit like and subscribe now so the next breakdown finds you when it counts. Form 1. Form SSA-44. The Medicare Premium Appeal. In 2026, the first IRMA tier adds $81.20 to your monthly Part B premium, plus $14.50 on Part D. That is $95.70 a month, $1,148 per year, priced on your income from 2 years ago. If you retired in 2024 or 2025 and your income dropped sharply, Medicare is still billing you at your working year's income level. A married couple with both spouses carrying a Tier 1 IRMA surcharge is looking at more than $2,200 a year in combined additional premiums. Form SSA-44 is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event form. It exists specifically for this situation. The Social Security Administration recognizes 8 qualifying events that allow you to request a recalculation based on your current income rather than the 2-year look-back. Marriage, divorce or annulment, death of a spouse, work reduction, work stoppage, loss of income-producing property, loss of an employer pension, and receipt of a settlement payment from a former employer. Retirement falls under work stoppage. It qualifies. To file, download Form SSA-44 directly from SSA.gov. Fill in the life-changing event, work stoppage, and the date it occurred. Attach supporting documentation, a letter from your employer confirming your last day of work, your first Social Security benefit payment notice, or the first statement from a pension showing distributions beginning. Any of these documents supports the claim. Mail or fax the completed form to your local Social Security office, or contact your local office directly to ask about additional submission options. If your appeal is approved, your premium recalculation takes effect for subsequent billing months. The sooner you file after your income drops, the sooner the savings begin. One form, about 20 minutes. For many recently retired households, more than $1,100 per person per year. Reinstated. If you retired in the last 2 years and are still receiving IRMA notices on your Medicare statements, pull your most recent statement and check the income year it reflects. If that income was from your last working year, Form SSA-44 is your next step. Form 2. Form 1000-40X. The amendment for the senior deduction, some 2025, returns missed. The One Big Beautiful Bill, enacted in 2025 as Public Law 119/21, created a new deduction specifically for taxpayers age 65 and older. $6,000 per qualifying person, available for tax years 2025 through 2028. If both spouses meet the age requirement, that is $12,000 on a joint return. The phase-out begins when modified adjusted gross income exceeds $75,000 for a single filer and $150,000 for a married couple filing jointly. Below those thresholds, the full deduction applies. Here is why some 2025 returns may not include it. The law was enacted during the 2025 tax year, and the IRS guidance needed to implement the deduction was still being finalized before your 2025 return was prepared and filed in 2026. If your preparer did not flag the addition, or if your return was completed before the guidance was fully in place, the deduction may simply be absent from your filed return. At a 12% tax bracket, the $6,000 deduction is worth $720 per qualifying person. Both spouses 65 or older, both below the income threshold, $1,440 back on a joint return. At a 22% bracket, that grows to $1,320 per person. Form 1000, 40X is the amended United States individual income tax return. The window to amend is 3 years from the original filing due date. So for a 2025 return filed by April 2026, the amendment window stays open until April 2029. There is no rush on the deadline, but filing sooner means your refund arrives sooner. To file, gather your original 2025 return. On Form 1000, 40X, correct the figures to include the additional senior deduction and attach a brief written explanation that you're claiming the additional senior deduction under Public Law 119/21, applicable to tax year 2025, and that you were 65 or older as of December 31, 2025. You can e-file an amended 1000 40X if your software supports it, or submit by mail. The IRS typically processes amended returns in 16 weeks or fewer. The refund arrives by check or direct deposit. If you turned 65 at any point before December 31, 2025, and your 2025 return did not show this deduction, pull that return today and look at the deduction section. If it is missing, Form 1000, 40X is the path to recovering it. Form 3. Form 5329. The missed RMD correction that most people pay too much for. Required minimum distributions begin at age 73 for anyone born between 1951 and 1959, and at age 75 for anyone born in 1960 or later. Miss 1, and the IRS assesses an excise tax on the amount you failed to withdraw. Before December 2022, that penalty was 50%. Half of the missed withdrawal paid to the government. The Secure 2.0 Act changed that. For tax years beginning after December 29, 2022, the missed RMD excise tax dropped to 25% of the shortfall. And if you self-correct the mistake within 2 years, by taking the missed distribution and filing the necessary return, the penalty falls further, to 10%. Run the numbers on a $15,000 missed distribution. Under the old law, the penalty was $7,500. Under the current law, the standard penalty is $3,750. Self-correct within 2 years. $1,500. And if the IRS determines that the shortfall resulted from reasonable error and that you're taking prompt corrective steps, they may waive the penalty entirely. The mechanism for both the correction and the waiver request is Form 5329. File it with your tax return for the year in which the full RMD amount was required but not taken. Attach a written statement explaining the error. The RMD age changed with Secure 2.0 and you misread the effective dates, or your brokerage did not flag the distribution requirement, or this was the first year your account crossed the threshold and the timeline caught you off guard. Then take the missed distribution as quickly as possible and include the date of the corrective withdrawal in your written explanation. When the shortfall was a first-time mistake, taken in good faith, and promptly corrected, these waiver requests often succeed. A one-year gap in distributions for a retiree who otherwise has a clean record is exactly the scenario the reasonable cause waiver was designed for. If you missed an RMD in 2023, 2024, or 2025 and have not filed a correction, the 2-year self-correction window may still be open. The excise tax you owe under current law is a fraction of what it would have been before, Secure 2.0. And a well-documented Form 5329 with a clear corrective action can reduce that fraction further, sometimes to 0. Form 4. Form 2210. The penalty waiver built specifically for the year you retired. When you leave employment, payroll withholding stops. Most people do not immediately set up quarterly estimated tax payments to replace it. The result is an underpayment penalty on the first retirement year's federal return, a charge for the difference between what you paid in during the year and what you actually owed. What most people do not know, the IRS built a specific waiver into the tax code for this exact transition. Under Internal Revenue Code Section 6654, if you retired after reaching age 62 during 2024 or 2025, and your underpayment was due to reasonable cause rather than willful neglect, you may request a waiver of the underpayment penalty. The mechanism is Form 2210, specifically Box A in Part 2. To use it, check Box A on Form 2210, attach the form to your federal tax return, and include documentation showing your retirement date and your age on that date. A letter from your employer confirming your last day of work or your first Social Security benefit award letter serves as evidence. The IRS reviews the request and decides whether to approve it. This is not a guaranteed waiver. It is a discretionary one. But when the underpayment resulted directly from an abrupt exit from employment, a situation Congress explicitly anticipated and addressed by writing this provision, that is the fact pattern where the waiver request is strongest. For 2025 returns, if you retired during 2024 or 2025, are 62 or older, and your return shows an underpayment penalty, Form 2210. Box A is worth filing before you send that check. The penalty may be smaller than the others on this list, $200, $300, $400, but it is still money that the law may not require you to pay. Form 5, Form 843. The first offense forgiveness that most people never ask for. This is the one your advisor probably never brought up because it has nothing to do with investment planning. It is a form you file with the IRS to say, "This penalty was my first mistake in 3 or more years. I have a clean compliance record. Please remove it." The IRS maintains an administrative relief policy that the agency calls first-time abate. If you have no IRS penalties in the 3 consecutive years immediately before the year in question, and you are current on all filing requirements with any tax balance paid or on an arrangement to pay, the IRS will frequently waive a first-time failure to file penalty or a failure to pay penalty. No hardship story required. No tax attorney needed. No need to prove financial difficulty. A clean record and the willingness to ask. The process starts with a phone call to the IRS at 1-800-829-1040. Identify yourself, state that you are requesting first-time penalty abatement, and give the tax year and the type of penalty involved. Many requests are approved in the same call. If the representative denies the request, you have the right to file Form 843, Claim for Refund and Request for Abatement, in writing. Include the tax year, the penalty type, the penalty amount, and a concise statement that this is your first IRS penalty in 3 or more years and that you have been compliant on all other filing obligations. If approved, the IRS reverses the assessed penalty. If you already paid it, the agency issues a refund of the amount abated, a $500 late payment penalty, a $400 failure to file charge. Each of these, if it is your first in 3 years and your record is otherwise clean, is a strong candidate for full abatement under this policy. Most people receive the penalty notice, write the check, and never ask. The ones who do ask very often get it back. 5 forms, each one written into law for situations that happen to real retirees. None of them automatic. All of them available to anyone who meets the criteria. Form SSA-44, for anyone paying IRMAA rates based on income they no longer earn. Form 1000, 40X, for anyone 65 or older whose 2025 return missed the new $6,000 deduction. Form 5000, 329, for anyone who missed a required minimum distribution and has not yet filed the correction under the new lower penalty rules. Form 2000, 210, for anyone who retired in the last 2 years and owes an underpayment penalty for the year the paycheck stopped. Form 843, for anyone who received an IRS penalty this year and has a clean 3-year history behind them. These are not loopholes. They are doors the government already built into the tax code, and not one of them will open itself. You have to be the one who sends the form. This is not financial advice. Every situation is different, and a qualified tax professional or CPA can confirm whether your specific circumstances qualify before you file. Every form mentioned in this video is publicly available on IRS.gov and SSA.gov at no cost. The instructions are included. If this changed what you plan to do before next April, leave the word forms in the comments below. It helps this reach another retiree before they write a check they may not owe. Hit like so, more people your age can find it. And subscribe here so the next one comes to you. Retirement paperwork is not exciting, but the right form at the right time can protect real money. See you next time.